then, and we're going to be talking about the earnings of Arvind Limited. And to talk more on that, we are being joined by Puneet Lalbhai, who is the vice chairman of the company. Hi, Puneet. Thank you so much for joining us today on ET Now. First of all, if we talk about your guidance, then guidance for an overall double-digit revenue growth for FY25 that you have given to all the experts out there, but this is to be powered by AMD as well as your garment business. Talk to us about the strategy going ahead. What gives you the confidence to achieve this guidance in the time ahead?
So we had a good quarter. We've posted already a double-digit growth this quarter. And I think the double-digit growth is driven predominantly by better demand globally in all our segments, both textiles and AMD. In the textile segment, the first half of last year was all about inventory correction and a very cautious environment. Now, finally, the world has pivoted towards thinking about growth. So we feel that for our textiles business, growth will come from improved demand overall, and also some of our new garment capacities kicking in and driving volumes up. So both volumes and better demand should drive growth in textiles, and AMD is a very strong segment and has been historically also strong. So that journey of strength will continue in AMD, and we should be able to grow at that 20% mark or slightly better.
Hi Puneet, good morning. This is Vinny joining in the conversation as well. Let's talk about some demand trends, right? Q3 FY24 onwards seems like the demand has bottomed out for the textile business, and now one could expect that improvement. Do you think this improvement that we are seeing and foreseeing that will continue in FY25, and this momentum is something that is sustainable, as well as what is your thought in terms of the demand trend?
I would be cautiously optimistic. I think there are a lot of headwinds globally in terms of conflicts going on at several places, Europe not having fully recovered from the shocks of energy and demand destruction due to the war situation. So I would be cautiously optimistic, because for the first time in many quarters, we have seen the narrative change at fourth quarter onwards of last year, from inventory reduction, cutting down sourcing, consolidation, to a little bit of growth, especially in North America and India. These are the two markets where we're seeing that growth that kind of helps us move away from that older narrative to a slightly better narrative.
All right, Puneet, if you are sufficiently stocked on the cotton for now, can we expect the working capital to come down in Q1 of FY25?
So yes, as and when we work through that cotton inventory, working capital level should come down, unless, of course, there is another need to take a strategic call. We feel that our overall working capital efficiency is good despite the higher inventories on cotton. So it's not a concern area for us.
Also, does the company have plans to reduce the overall net debt gradually, especially with the reduction in when you talk about the long-term debt? And what is the planned increase in terms of capex for the newer projects going forward in the AMD segment, garment segment? And are you happy with the current debt levels?
We are very comfortable with the current debt levels. Last year also, we reduced about 250 crores of long-term debt. And now the business is in growth mode. So we will see working capital go up. However, we are not very aggressively trying to pare down debt right now. Now we feel that the debt is in very comfortable territory, and we will grow. We will continue to use our free cash flow that we generate for growth, now that we are quite comfortable with the overall debt.
Lastly, also Puneet, if you could give us an update on the capex for the new projects and their contribution in the AMD as well as the garment segment.
We had guided that we should be spending around 600 crores across 2 years. Last year, we spent about 260 odd crores on capex. This year, we should spend the balance, plus perhaps looking at some positive developments on the opportunity front, we might end up spending a little bit more than 600 crores across the 2 years.
Puneet, multiple roles there, Vice Chairman at Anup Engineering also. So, let's talk about Anup Engineering then a little bit. And, when you talk about it, you've recently acquired that 100% stake in Mabel Engineering. Tell us about how this new plant is complementing your existing capacities. What could we expect in terms of synergies for your top line?
Certainly. So Mabel gives us a strategic presence in South India. Also, the way Mabel is structured is it's ideal for smaller vessels with special metallurgy. And that complements our capabilities. It also makes a few products that we at our Gujarat locations don't make. So from a product perspective, from a location perspective, and from a strategic perspective to efficiently do smaller but more complicated metallurgies, it gives us an advantage. Currently, Mabel is around that 50 crore mark, but we expect it to continue to remain 10 to 12% of our overall revenue. As we grow here, we should also be able to grow at Mabel. There is plenty of headroom to grow there as well in terms of space and in terms of utilization of the current assets. So it's a good strategic fit for us, and that's why we've considered it and gone ahead with the acquisition.
Also, Puneet, for Anup Engineering, we have seen good growth in your financials as well. So, what is the growth momentum that you see in the times ahead, especially in the top line, as well as what is the overall outlook for the next 3 years if we want to pencil in that growth?
So we have a very healthy order book going into this year. So our guidance of a 20% plus, closer to 25% growth on top line is intact. The way you should look at our margins is that they will continue to remain above that 20% mark. So we are currently at that 22, 23% mark. It should be there and thereabouts. So as we get into more complex metallurgies, we may earn more per square meter under the crane, but because of the raw material impact, the margins may change by half a basis point, 1 basis point, but we are guiding reasonably stable margins also. So very good growth with stable margins is how you should look at the year coming ahead.
Puneet, just a last question in terms of exports. Can we expect the share of exports to increase in your overall order book pie in FY25 for Anup Engineering?
I think the share of exports is already quite healthy at 40%. 31% direct exports and 10% deemed exports. Might marginally improve from here. Ideally, we would like a 50-50 mix, and we're working towards that goal. However, at our current order book, it looks like we will come close to that figure.
Okay, Puneet, thank you so much for joining in with us this morning on ET Now and talking to us about Arvind Ltd as well as Anup Engineering and talking to us about what we should be expecting. That was the Vice Chairman of Arvind Ltd, Anup Engineering, Puneet Lalbhai, joining in with us this morning. But with that, let's just slip into a very short break.
If you like this video, then like, share and subscribe to ET Now.